All right, traders, welcome to today's recap. This is Christian from Tribeca Trade Group, and let's get started with the recap. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving out any advice or recommendations. So themes of the day, obviously this pounding by the banks. I mean, this is pretty atrocious. I kept hearing today, in my ear with, because I've got financial media up, I either have CNBC or Bloomberg on, I kept hearing about the regional banks. And, of course, that was really kind of what people kind of looked at first, right? And of course, if you look at the weighting, a couple things to kind of point out here in the banks, and then I will go into the overall indices. But the KRE, first of all, the regional bank ETF is an equally weighted ETF, and this will rebalance, by the way, on Friday, not this Friday, next Friday, right? That's quadruple witching, which again, we have a very big week that's coming up, because not only do we have the jobs report tomorrow and inflation reports next week, but we also have quadruple witching where all the indices will rebalance, S&P and NASDAQ. So yes, this name was the highest weight out of an equally weighted basket, because what does float around between quarter to quarter between the index rebalances is price. So apparently, like, this name actually did pretty decent coming into today versus all the other banks. But regardless, right? This move in the banks today, down 8% for this regional bank. If you look at the performance, I mean, it was pretty widespread. Also, in terms of put activity, I mean, one of the things that I was wondering for the day was whether or not they were going to pile on and start buying puts in a bunch of different banking names, and they certainly did. We saw a big put buy in JP Morgan. That was the biggest put that I saw for today. But basically every bank, I saw puts in Citigroup, Wells Fargo, Bank of America, Blackstone, which we talked about, which I thought was a good short setup for the day. But you could see, of course, that name, SIVB, was down 60%, which also SI was down 42%. But you could see how many names were down in this. But you look at the larger banks, which is KBE is all banks, but KBWB, right, is what's known as the BKX index. And if you look at the performance here, right, you're going to see that it wasn't just those couple of banks. I'll wait for this for Bloomberg to come back up, but that ETF, let's see if let's try this one more time. There we go. Right. Oh, it looks like SIVB was in this too, but you could see other banks were down. Bank of America was down. Schwab was down, right? There was a big block trade in the beginning of the day in that name. So again, a couple names really got hit the most, but the action was pretty widespread in terms of, names down anywhere from 4% to 10% on the day. There was quite a bit. So let's look at this chart really quick. So again, like I said, I heard financial media talking a lot about this. But it wasn't just the KRE, ETF. So that is a firm break of support. Also, when you look at this, I mean, you could kind of consider this some type of, we've been seeing a lot of these abstract inverted, not inverted, but abstract head and shoulders. And, this kind of looks like the same too, with a break of the value area for the year, 56.63. So yeah, I mean, I don't invest particularly a lot in the banks myself, but I understand that they're part of the market, right? And when you see something like this, it's generally not a good thing when you see an area like the banks break down. Let's go over what the S&P looks like. So first of all, here's what we look like for the weekly chart, which again, still even sideways, even though we've got working on what almost looks like a bearish engulfing candle, but it's a decisive break of the 200-day moving average. So we have been moving in this range for a couple weeks, and we're at the lower end of it. In fact, we broke the lower end of it. So I would watch for the next level down, 38.66, and we'll just kind of have to see what we do when we get down to the next level. Looking at the 1 hour chart too, we did, this was tricky for the day because we started to kind of rally, and we've seen a lot of these days. I think over the last year, we've seen a good number of days where we actually start to go in one direction, get somewhat rejected, and then completely, go the other way. And it's been more often than not when that happens, it's start up and then go down. So yes, I even got shaken out of a trade. I had a hedge trade on, which I mentioned in yesterday's video, which was SDS. And I said, hey, we're moving back above value. I'll take this trade off. Now, once we kind of moved back in, I decided to put something else on. We could talk a little bit about the small caps too, but I mean, this was the 80% rule that I had been talking about. It just, markets don't go sometimes in a straight line. And there you go. We broke 39.52 and we just are continuing to the downside. So this kind of sets up, this data that comes out tomorrow and next week. I mean, it's still going to be important data. I don't know. Did somebody get the word out that the jobs number is going to be strong tomorrow? I have no clue. But bottom line is, what the market is telling you in the price action, and everything else. Like I tend to put some things out on Twitter where I talk about, Fed fund futures, and I talk about what the Fed could do. But really, the most important thing, in my opinion, and I never argue with it, is the price action, right? And you have a support resistance level, and you break that, and it's a sign of what's going on in the marketplace. So that's S&P. 3860 is a level on the downside there. And that lines up very closely. It's kind of funny because it's a little bit of the deja vu all over again, because I talked about these levels. I think when we made our first break of the 200-day moving average a couple weeks ago, I mentioned like this 3866 level, and the 1 hour VPOC that I just mentioned could be a level that we go down to. And you don't, sometimes the market just doesn't want to go there in a straight line, right? And obviously we got rejected along the way in here at the bottom of value. To look at the Qs, we'll look at the Qs next. They're still above the 200-day moving average. Yes, they had a nasty day too. They were sitting, they made this nice move in the morning. They looked like they were holding up quite well. They held this support, right? And we got back into this range where we were in the beginning of the week, got rejected again, and slid, pretty decently down into the value area. Notice the 80% rule is still in effect here, right? So that's 290. By the way, one thing that I talk about with these 80% rules is once you get to the bottom of value, right, you have to kind of see what takes place there. Just because you complete the 80% rule doesn't mean that you're going to start to go reverse and go the other way. You can continue in that direction. It's like anything else. When you get to a support level, you kind of have to watch to see what happens there at 290.70. All right. And then IWM. So again, that's 290.70 on the 1 hour chart. And I think, people will be watching, of course, the 200-day moving average as well as the 50-day moving average. Right. IWM, so why did this start to show weakness? You go back to this KRE chart, right, which started, and by the way, like obviously, today was the big move down 8%, but this was not looking healthy. And I think I mentioned this. I don't remember if it was in yesterday's video, but I know I've mentioned the banks a couple weeks. They were one of the only groups on Friday. If you go back to Friday's price action, right, that kind of stood out like a sore thumb. Something didn't seem right with the banks, right? Going back to, remember, Friday was a very strong day. The market breadth was very strong on Friday, but the regional banks were down. I think it was 1.2% on that day. So again, that sometimes that could really be a signal that something's not right in a group. So again, that was Friday's action, and that's where this thing really started to kind of begin to kind of come undone a bit. But yes, it wasn't just today, right? I mean, this thing has been trending down, doing having some difficulty now for the better part of a week or two. All right. And of course, why am I going back to the banks here just for a second? Because they're the biggest weight in the small caps, right? And that's also, Friday, the small caps had a nice day, right? And then of course, got rejected on Monday with a bearish engulfing, and then, has completely slid down. And that's what I played today on the short side. I just thought, I didn't really want to press the banks being down, 5 or 6% on the open. It did work, by the way, but I just thought that the small caps would also, get hit. And I'm out of that trade. I just put that trade on for a day trade. All right, here's my trade blotter for the day. I did a lot of unwinding of some trades for the day. A lot of names that I had been holding that were doing quite okay, like the ATKR. I jumped out of some of these things early. I actually had a couple starters on in the beginning of the day. I started a Skyworks position, but if you look at the semis, right, which had such a strong day, and this market will give mixed signals like this. The really, I think the main thing is, like, and if you get fooled on some of these things, everybody does. You just kind of have to understand that the market is changing. And sometimes things will look good for a little bit. We took out that 1 hour VPOC, virgin point of control, and then kind of moved back. And, I mean, even down 1.9%, it kind of just puts us back into this range. So I think the semis will be something to watch if this market does improve. Was today enough? So kind of the next thing to kind of move on to, we went over the major indices, we went over the semis, we went over the banks, to talk a little bit about the market dynamics. We know that we've been in a bearish crossover for a month now, in terms of the NYSE summation index. So that is continued to, there's not been any fooling anybody with that, right? That has been in a like I said, a bearish crossover with the 10-day moving average for the last month. And I think if you look at the left of your screen, this was a pretty good washout day. I don't know if it's extreme enough. So let me bring this up. Sorry, I thought I had this up. Just bear with me 2 seconds, and I'll bring up breadth. All right, so there you go. So you could see this is what the indicator does on the left, right? So that's market breadth for the day, and you could see it's negative 1289. So this is also NYSE. I put this into Bloomberg. I made up my own custom index, and this is down volume divided by up volume, right? And what is useful in this is to note when it gets to extremes, and notice in the beginning of December. So if we kind of overlay this, so this was on December 5th, I believe, where we had some really negative breadth, right? Let's go to that day in the S&P, right, which was here, was it? I think it was here, right? We did have some follow through, and again, it did not provide, so even though the breadth was really nasty that day, see if I can make this larger in here. No, there's this one day that has screwed everything up. Let's see if I can zoom in over here, and it should come up on this reading. So December, so that's right here on this day. Okay, so notice that the breadth is as negative as it was there. So that did not indicate, right, that was a short-term bottom or anything of that. So it's not as extreme. So it's extreme as we haven't seen that type of breadth since 12.5, but that did not indicate like a short-term bottom or anything like that, because we continue to move down, and we continue to move down for some time before things improve. So, people like to throw out that term sometimes, capitulation, when things get really bad, but I don't think this was bad enough, even though it was the nastiest breath that we've seen since that 12.5. So it'll be interesting. I think that if we, going back to what I've said in yesterday's video, right, and we talk about the Fed, the Fed fund futures, right, which is basically indicates to us what the market is pricing in for the next meeting. They start, after the the beginning of the testimony from Powell 2 days ago moved the Fed fund futures from 30 basis points to over 40, indicating that there will be a 50 basis point hike. It'll be interesting to see if this starts coming back in. And it only moved a little bit today, right? So if we look at the last 30 days, right, that's off the highs of where it was earlier today, but So now it becomes the question is, will the Fed begin to backpedal? And I don't have the answer to that question yet. It will be interesting. I think this data that comes out tomorrow, if it comes in hotter than expected, as well as next week's, right, then I think that probably we're going to get another 50 basis point hike. But you might begin to see more things like we're seeing today, right? To me, it is just too many rate hikes. And as I talked about in the member video today at lunchtime, I think really kind of what has transpired here is the last Fed meeting, they raised 25 basis points, right? And the market started to get comfortable with a couple more 25 basis point rate hikes. Now that you kind of move the needle back to 50 basis points, right? The market is not taking that well. And I think that's kind of what we're seeing here, along with some of the other damage that's being inflicted. You begin to see when you have these higher interest rates and more of a difficult environment, right? It comes back to the saying that sometimes you hear in the markets that, when the tide rolls out, you begin to see who's been swimming naked, right? So it's the same type of principle sometimes in trading when there's a lot more stress in the marketplace. You begin to kind of see where really some of the bad companies lie, right? And they're being exposed at this point. Credit spreads are also one other thing. I'll kind of leave it here for the video for the night. Credit spreads are something also to pay attention to, to see if any stress. So they came from, so let me give you more of a 2 or 3 year view here. Right. So if this kind of gives you some sense that credit spreads got really tight. So this is more of like a rubber band snap. Credits did widen today, right? But it's really not at an extreme level at all, right? In fact, you could see where we were last June in terms of credit spreads. Again, this is IEI over HYG. It's very important. People tend to look at HYG standalone, but really what you want to be doing is looking at the spread between the high yield prices and bonds and the treasury prices, right? Because they both have interest rate risk. What you try to do when you look at one versus the other is to remove the interest rate risk and to only look at the credit risk, right? And that's why you put one over the other. So as of now, right, and if the Fed is kind of saying, geez, wow, the market, I heard banks had a bad day. What are credit spreads doing? Was there any major stress in the system? So this is not showing that there's any major stress yet. I mean, this was a big one-day move for credit spreads, but again, you have to kind of look at the level that we're coming from, right? So that's a 1% move. You could see there hasn't been any of those 1% moves, over the last couple months. So it's a big one-day move, but the overall level is not extreme. All right, guys, that's it. Again, I think with all this data coming out for the next for tomorrow, right? And here's what they're looking for. Right, for tomorrow, they're looking for 225, and I really think there's going to be so much fuss over the change in the private payrolls, but it's really going to be, in my opinion, this number. If this number is really big one way or another, right? That's the average hourly earnings month over month. It's another gauge of inflation. So I think if that number really deviates from expectations, you could see a big reaction. All right, guys, have a great night. See you tomorrow.